So when we talk about finance, you need to remember that all the activities related to this concept. So financial management, finance, is a matter of how you are going to obtain funds for your business, for your company, and these funds can come from different resources, such as banks, such as angel investors, depending on the size of your company, right? These are, in my personal opinion, for this subject, the two main concepts that you need to keep in your vocabulary. The differences between cash flow and profit, and also the concept of time value of money, okay? That money right now is much more important than the money in the future, okay? That's it. So these are the two concepts that I want you to keep for now. First of all, letter A, cash flow, and letter B, the time value of money. Good, pretty good. After, another definition that I would like you to keep with you is related to forecasting. The forecast is more than a planning, or it's not a planning, actually, it's more a prediction of the future. So you are going to analyze all data that you have, all data you have in your hands, and with this information, you are going to try to predict the situations in the financial point of view, obviously, in the near future or in the future, right? So this is the other concept that I would like you to keep in your vocabulary. The next one is budget. Budget. In general, budget is composed by different types of information, such as the expenses, the cost, the revenues that you intend to have during a period of 1 year. Okay, this is a planning. You can have a budget for your company, and you also can have a specific budget for a specific department inside a company. Okay, that's the minimum definition that I can give to you. And it is really important because you can identify and plan all the expenditures that you are going to have during the period of the year, during this period of the year. Okay, that's why it is one of the things more important here. The other one is the difference between debt and credit. We need to remember that these two concepts here, they have different meaning depending on the subject we are talking about. So if we are talking about accounting point of view, then these two concepts are going to have one meaning, which is the debt is in the left side, balance sheet, and credit is in the right side. Okay, so credit in the left side and the other one in the right side, okay, of the balance sheet. So this is in the accounting point of view, okay? But if we are talking about finance, then the definition is different, as you might know. So if you are using your credit card, if you use it in a debt way, it means that you have the money, you own the money. But in a credit way, it means that you are borrowing money from the bank. Borrowing money. Good. Pretty good. The next one is related, letter F, to the 10 principles. The 10 principles of finance are going to guide all the decisions and all the structure of financial management, okay? And they are 10, as I told you. You need to remember at least 5 of them to have a minimal knowledge of it. I would give you a couple of examples. So the risk trade-off, which means that you are not going to take an additional risk unless you have an extra gain, an extra earn in this decision, right? This is the first one. The second one is the time value of money, that a dollar today worth much more than the dollar in the future. The next one that I remember right now is that taxes bias business, which means business decisions, which means that when you are going to, you are going to move your company from one city or town to another one, then one of the main topics that you should consider is a matter of taxes. So taxes are going to guide your decisions, right? This is another one, the third one. The next one, what else? I don't remember all of them. Cash is the king, so not profit. Cash, not profit is the king, which means that we are going to check this in the next two slides. It's a matter of profit considers accounting figures, and finance is going to consider the actual figures for today. So if I am talking about cash flow, it means that it is the real money that I have in on my hands. But if I am talking about profit, you receive part of it today, part of it in the future, depending on the revenue, depending on the accounts payable or accounts receivable that I have. So it depends on many factors, depreciation and things like that. So cash is king and not profit, okay? And we have the other axioms or the other principles that I would like you to remember at least 5 of them. Good? If everything is okay, we are going to move to the next part, which is cash flow. Just let me stay here a little bit, just to record the board. Pretty good. The second chapter was about cash flow. As I told you right now, cash flow is the, how could I say, it is the real money that I have on hands, okay? So it is something that I could use right now if it's needed. And the difference between these two ones, as I told you before, is that cash flow is happening right now. It is the real money that I can use. But profit is going to consider accounting principles, which means that depending on which subject I am talking about, I'm going to consider that sometimes I could have a profit. If I'm going to check my income statement, I will see that in my company I have profit, a positive income. But if I move to cash flow, I could be negative. And this is something that could happen because here I have some receivables for the future, from the future. And here, no, here is a matter of today. That's why incremental cash flow, which is the concept that you know, incremental cash flow matters because it is the incremental money that I have today and not tomorrow, not in the future, not in the next month. It is the money that I have today. That's why it is so important to increment the cash flow, okay? And we have 3 types of cash flow. The first one is the financial cash flow. The next one is the operating cash flow. And the last one is the investing cash flow. In a matter of, how could I say to you? In a matter of trying to make it more simple for you, this money comes after I pay all my taxes, all the, what else? All the administrative expenses comes from a financial point of view. Operating comes from revenue. Let me put here, administrative. And investing obviously comes from investments. And it can come from different types of resources. For example, from bonds or shares. Okay? Bonds or shares. Stocks and bonds. Stocks, I don't know who explained this, but in this group, I remember that Juliana explained about bonds and another girl explained about stocks. I don't remember who, but they gave us a couple of definitions, good definitions about it. And I would like you to check their videos after, when you can, obviously. But stocks is a matter of shares, or I could say papers. Papers that prove that you own a company, okay? You are a big investor, or you are a small investor, or something like this, but it proves that you own part of that company, a percentage of the profits and the revenues of that company, okay? And a share, when we talk about shares, we need to remember that we are going to invest our money expecting that these shares are going to value in the market, depending on the fluctuation we have in the market, in the stock market. And with this fluctuation, we are expecting to gain, to earn some profit when we sell these shares to other people, to other investors. Okay, so it depends on time that I am investing, and obviously the money that I am investing in it. Okay, and when I am talking about bonds, and by the way, this is for private companies, okay? Private companies. Here is not a matter of buying and selling. Here is a matter of lending, borrowing money for the government. So here I have to tell this buying selling process. And here, in the other hand, we are borrowing money for the government, expecting to receive a standard profit in a well-determined period of time. Okay, in this situation, I know when I am going to receive my money back. This is a high risk investment. Not high, depending on the way we are talking about, but in general, we consider to be a high-risk investment. And here is a low risk. Actually, it used to be. Nowadays, it is weird. Since Selic is really low nowadays, this is not a good investment anymore. But it used to be. So the general concept is this one. We are not going to discuss the investments. We are not going to discuss investments here, but only the definitions. Okay? Good. Another word that I would like you to keep in your vocabulary is broker. I know you know it. Oops, I think there's somebody here. Oh. Okay. So I know you know it, you know this concept of broker, but it is a kind of a person or a company that is going to intermediate the business, now the investments business, right? So this is the concept that I would like to keep too. And also we have here stocks that I told you, and we have different types of investors here. The preferred stocks and the common stocks. The preferred stocks are the ones who are going to receive some benefits because of it. So for example, most of the time they are going to receive dividends, or also when the company may be bankrupt, they are going to be the first ones to receive their investments back, or at least part of these investments. Okay, so we have two different types: preferred holders and common stockholders. Good. I think that's it about concepts. The last part about finance is related to the ratios, financial ratios. What is happening here? I think there's a problem in my equipment. Okay, pretty good. So the fourth topic is a topic where we have discussed about investments itself, when we need to have tools to help us to decide if we are going to invest in some project or not. The first concept is the rate of return, or we could say internal rate of return. The rate of return is the percentage, the rate that we are expecting to receive from an investment. The next one is payback. The payback is the amount of money necessary to receive back my investment in a period of time. So it's a matter of investment. I'm going to invest my money on it, and I would like to know in a general way how much I'm going to receive per month until I finish this investment, until I recoup this investment. Okay, this is the payback. The next one is the NPV, net present value, which is another tool really important and really useful to decide if I'm going to invest in a company or not. And the last one is the internal rate of return, IRR, which is when I have the NPV equal to 0. This is an important concept because it's going to give me the right period where I'm going to receive back my amount, the minimum rate necessary to receive money back. So if I have my net present value 0, means that in that ratio, that rate, I cannot accept a project that is going to give me less than that war. Okay, so that's the concept. And that's it with financial management.